Clause 25, which it was convenient to also debate Schedule 5, and I call on Gareth Davis to resume his contribution.
Well, thank you, Mr. Mundell, and I'll pick up where I left off by just asking the Minister to provide confirmation on the 3 points that I listed, and to also provide an assurance that HMRC guidance has been sufficiently clear on these points so that those who are affected are aware of the full implications of the changes that are being made. Finally, in the case of joint ownership, the Chartered Institute is calling for an administrative easement to allow declarations to be backdated, and I just wanted to take the opportunity to see if there was any any possibility of such an easement being implemented and whether the Minister's considered that. I've not been able to raise all of the many points that the Chartered Institutes have raised with me, and I apologise to them for that. But I will say that I am sure the Minister is engaging with the Institute. I know in opposition he spent a lot of time with them, as well as he will be doing with the industry, and so would encourage him to speak to them and get their guidance and input, as I've tried to lay out in my remarks. Thank you.
Minister.
Thank you very much, Mr. Mundell. And actually, may I start by putting my thanks on record to the Chartered Institute of Taxation. I know they were great support to me during opposition and continue to be a very important stakeholder for us in government. I'll try to respond, Mr. Chair, to some of the points that the Shadow Minister raised during his contribution. Firstly, he raised the concerns that the Chartered Institute had articulated around trading and property income boundaries. Now, there are established principles underlining what is trading and what is income from property. The bright line tests which have been put forward distort those principles rather than clarifying them. Whether activity is income from property depends on the nature of the activity undertaken and specifically how the profit is derived. If the profit is derived from the exploitation of land, then the income is taxable as property income. The FHL rules provided for specific reliefs, but has always been property income, not trading for tax purposes. Categorising some property income arbitrarily as trading would give more reliefs than previously as FHLs. The Opposition Minister also raised specific concerns regarding how the repealing of the FHL rules apply practically to landlords and how this may affect them. And first, I can reassure him that HMRC has already published guidance regarding these changes and will be publishing more guidance ahead of April when these changes come into effect. We've also engaged with industry since the announcements to ensure we are aware of their reaction. Moving on to some of the other points the Minister raised in relation to business asset disposal relief and rollover relief. We have considered the impacts of these changes on these two reliefs, and it will depend, of course, on an individual's personal circumstances, but broadly, each person would need to dispose of the whole or part of an FHL business or dispose of assets which were used for the purposes of an FHL business that has ceased before April 2025. We have been fair in our approach not to restrict relief where someone has had an FHL before repeal, and individuals should, of course, consult online guidance or a tax advisor before making any decisions. The Opposition Minister also raised questions around married couples, and we have considered the impact of these changes on married couples and civil partners. Removing the FHL rules means that the married couple are now subject to the same rules as other landlords. For married couples, income is assumed to be split 50-50 unless a declaration is made to split the income in a different proportion, which must be the same as the proportion of ownership between the couple. If they want to change the proportions, married couples will now have to make an election for joint ownership arrangements as per the usual process. There will be a deadline of April for married couples to adjust these changes, as we cannot backdate such elections. This has already been set out online following the consultation on the draft legislation, and as I mentioned, further online guidance will be available. I think I've hopefully covered most of the points that the Opposition Minister raised in his questions. I'll simply conclude by recognising that my gratitude to the Minister, the Shadow Minister, for not opposing these regulations. Obviously, it would be noteworthy if he had changed his mind since he was in government to change position on that. I'm not entirely sure whether all of his colleagues are on exactly the same page as him around this, but maybe I won't pry that at this stage of the consideration of these clauses, Mr. Chair, but perhaps his slightly caveated response to the clauses we're debating now reflects some discussions happening within the opposition front bench. But notwithstanding whatever is happening behind closed doors, I welcome their support for these clauses in the committee.
The question is that clause 25 stand part of the bill. As many as are of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. Schedule 5 has been debated, so we will proceed straight to the question that Schedule 5 be the fifth schedule to the bill. As many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to clause 26, with which it will be convenient to debate clauses 27 and 28 stand part. The question is that clause 26 stand part of the bill. Minister.
Thank you very much, Mr. Chair. And clause 26, which I'll begin by addressing, makes changes to maximise the potential of the UK's world-class visual effects industry, whilst clauses 27 and 28 make changes to ensure continuity for companies claiming expenditure credits for film, TV and video game production by aligning the legislation with equivalent provisions in the previous tax reliefs. Mr. Chair, the UK is a strong performer in visual effects production and is home to several Oscar-winning companies. However, in recent years, there have been reports of visual effects activity moving overseas. Stakeholders report that this is because of the 80% cap on qualifying expenditure that relates to the Audio-Visual Expenditure Credit, or AVEC. Currently, companies can receive AVEC on up to 80% of their production costs, including their visual effects costs. Visual effects work is done virtually, so companies may place 80% of their production costs in the UK and then place their visual effects costs overseas, particularly in countries like Canada and France that offer special tax incentives for visual effects. Now, in November 2023, a call for evidence on the visual effects industry was published, and this provided substantial evidence for visual effects work moving overseas because of the 80% cap and because of increased competition from other countries offering targeted visual effects tax incentives. Separately, previous tax reliefs for film, TV and video game production are being phased out and will be fully replaced with expenditure credits from April the 1st, 2027. Companies are indeed already able to claim expenditure credits instead of the tax release if they wish. Now, to look at the specific changes being made by these clauses, firstly, the changes made by clause 26 will increase the amount of AVEC awarded to UK visual effects costs in film and high-end TV production by 5 percentage points to a total credit rate of 39%. The changes remove AVEC's 80% cap on qualifying expenditure for visual effects costs, so that all of these costs, including those that are above the 80% cap, may receive the enhanced 39% rate of relief. Around 1,300 companies claim film or high-end TV tax relief and stand to benefit from these changes, and the additional tax relief is expected to cost £75 million per year from 2028-29. Moving on to clauses 27 and 28. Firstly, clause 27 sets out that the previous tax release and the new expenditure credits both require companies to provide cultural certificates from the British Film Institute to support their claims to relief. HMRC requires these certificates to be in force at the time that a claim is made. Now, the new expenditure credits legislation is less clear on this requirement than the previous tax release legislation, as it requires certificates to have effect at the end of each claim period rather than only at the time that the claim is made. The changes made by clause 27 will therefore align the expenditure credits legislation with the tax release legislation to clarify that cultural certificates must be valid when claims are made and ensure continuity of treatment between the previous tax release and the new expenditure credits. Secondly, regarding clause 28, the previous tax release and the new expenditure credits both have rules on the treatment of expenses that are not paid within 4 months of the end of the accounting period in which they are incurred. The tax relief rules allows for these expenses to be deducted from profits, but do not allow additional relief on them until they are paid. The expenditure credit rules prevent the expenses from being deducted from profits at all, that is, until they are paid. The changes made by Clause 28 will align these expenditure credit rules with the tax relief rules, so the unpaid amounts can be deducted from profits that are still ineligible for relief until they are paid. This will ensure continuity for companies which are used to the treatment of unpaid amounts under the previous tax reliefs. In conclusion, Mr Mundell, the changes to the audio-visual expenditure credit will boost the UK's offer for visual effects in an increasingly competitive international environment and incentivise more visual effects work on UK productions to be done here in the UK. Furthermore, the changes to the expenditure credits legislation will align it with the more familiar tax relief provisions, ensuring continuity for film, TV and video game companies, and I therefore move that clauses 26, 27 and 28 stand part of the bill.
Mr Davis.
Thank you, Mr Mundell. As the Minister set out, clauses 26 to 28 create an additional relief for video effects, or VFX as I'll refer to it, expenditure, while making administrative changes to to align audio-visual and video games expenditure credits with older reliefs for film, TV and video games. We announced the additional relief for VFX expenditure at the spring budget of 2024 as part of a wider package to support our world-leading creative industries, which, by the way, grew at over 1.5 times the rate of the wider economy between 2010 and 2019, a remarkable success for any sector. The consultation which we launched on the design of this policy directly informs these clauses, and we will not be opposing them. The one suggestion raised in the consultation, which the government has not chosen to take forward, was to allow companies claiming the independent film tax credit to also claim the additional tax relief for visual effects. The government has said it does not believe this exclusion will have an adverse impact on companies, but it would be really helpful to hear from the Minister what assessment was made of the benefit to smaller visual effects studios had the scope of the relief been widened in the way in which many responded as part of the consultation. Spring Budget 2024 also announced a 40% relief from business rates for eligible film studios in England for the next 10 years. My understanding is that this has not yet been implemented by the new government, and it's in fact been referred to the Subsidy Advice Unit. And I understand in the last couple of hours, while we've been on break from this committee, they have now reported its findings, and I'd be grateful if the Minister could update the committee on what this may mean for the future of the measure and the expected timeline for the delivery. Thank you.
Minister to respond.
Well, thank you very much, Mr Mundell, and I thank the opposition, the Shadow Minister, for his comments and for setting out some of the important context around these tax reliefs and expenditure credits and why they're so important in terms of supporting growth in the UK economy, and specifically in terms of the independent film tax credit, a question that he raised. As he will understand, I'm sure, films claiming the independent film tax credit will receive a 53% rate of audiovisual expenditure credit on up to 80% of their production costs, and that includes their visual effects costs. The independent film tax credit therefore provides highly generous support for visual effects costs within independent films, and separating the additional tax relief for visual effects from the independent film tax credit helps to ensure that both schemes are simple and easy for companies to understand. In relation to a publication that he says was made in the last few hours, that is so hot off the press, I'm not even authorised to speak about it yet, but I'm sure I haven't been briefed on it because I've been getting ready for this committee, but I'm sure if it has been submitted, then the right officials and ministers will be looking at it as soon as possible.
The question is that clause 26 stand part of the bill. As many as are of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. Clauses 27 and 28 have been debated. With leave of the committee, I will put a single question on those clauses. The question is that clauses 27 and 28 stand part of the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to clause 29, and the question is that clause 29 stand part of the bill. Minister.
Thank you, Mr Mundell. Clause 29, which we're now debating, makes small changes to the rules for enhanced support for R&D intensive companies with a registered office in Northern Ireland. Now, at Spring Budget 2023, the previous government announced an enhanced rate of relief within the R&D Small and Medium-Sized Enterprise Scheme applying from April the 1st, 2023. Separately, from April 2024, slightly different rules applied for R&D intensive companies with a registered office in Northern Ireland, allowing them to continue claiming relief on a wider range of overseas expenditure than companies in Great Britain, whilst introducing a cap on the amount of relief that can be claimed. Clause 29 amends the new rules introduced last April to reflect the particular market conditions in Northern Ireland and ensure consistency with the UK's international obligations. This will introduce some additional requirements around the accumulation of aid and reporting, which will apply to claims made on or after October the 30th, 2024 by eligible companies with a registered office in Northern Ireland. Now, a very small number of claimant companies in Northern Ireland are expected to be affected, whilst the vast majority will continue to be better off compared to their counterparts in Great Britain. This is because their claims are too small to be affected by the cap, but they will still be able to claim on overseas expenditure as before. The OBR have certified this measure as having a negligible impact on the cost of the relief. Mr. Chair, the Government is committed to supporting R&D investment across the UK through the R&D tax reliefs, which play a key role in supporting the mission to kickstart economic growth. These changes will ensure the R&D reliefs reflect the particular market conditions in Northern Ireland and ensure consistency with the UK's international obligations, and I therefore move that this clause stands part of the bill.
Mr. Davis.
Thank you. As the Minister set out, Clause 29 amends the measure in Northern Ireland to set a new cap in law of €300,000 on a 3-year rolling basis alongside other sources of relevant aid. The existing cap of £250,000 is currently defined in regulations. I would be very grateful if the Minister could inform the committee as to why these provisions have been moved from regulation into law and what the implications of this change will be. HMRC notes that when claiming ERIS, companies with registered offices in Northern Ireland now need to take into account other relevant aid which they have received. And so I would ask the Minister what steps have been taken to ensure that those companies are aware of this change and equipped to satisfy this new requirement. Thank you.
Minister to respond.
Well, thank you, Mr. Chair. I thank the Opposition Minister for his questions. I think it's worth emphasising, Mr. Chair, that this is a small change compared with the rules which already apply from April 2024, and in practice we expect a very small number of companies to be affected by the change, with very few claims to be made before April 2025. Since this amendment will be a key qualification to the tax rules for a part of the UK, it should be legislated in the Finance Bill as part of the budget process. I hope that helps to explain the process which we're taking to implement these changes, but also reassures him that these changes are indeed very small and will affect a very small number of companies.
The question is that Clause 29 stand part of the bill. As many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to Clause 30. And the question is that Clause 30 stand part of the bill. Minister.
Thank you, Mr. Mundell. Clause 30 makes small changes to the higher rate of relief available for R&D intensive SMEs to ensure the R&D reliefs remain fit for purpose whilst providing clarity to businesses. Mr. Chair, the Government recognises the important role that R&D plays in driving innovation and economic growth, as well as the benefits it can bring for society, and the R&D tax reliefs play a key role in this. That is why I was pleased to announce in the Corporate Tax Roadmap published at Autumn Budget that the Government is committed to maintaining the generosity of the rates in both the merged R&D expenditure credit scheme and the enhanced support for R&D intensive SMEs to increase certainty for companies when making investment decisions. In the Finance Act 2024, the R&D intensity calculation for the enhanced rate of relief did not take account of any expenditure for which a company was entitled to claim the research and development expenditure credit. This meant that some companies that were supposed to qualify as R&D intensive might not meet that threshold. The change made by Clause 30 will therefore ensure that research and development expenditure credit qualifying expenditure is included in the calculation of the R&D intensity ratio as was always intended. This will apply to all claims for the enhanced rate of relief from its introduction in April 2023 and to expenditure incurred from April the 1st, 2023 in an accounting period that began before April the 1st, 2024. This change will affect some small and medium-sized enterprises that have a high R&D intensity and claim the enhanced rate of SME payable R&D tax credit relief. This is a small technical change, and so it is not anticipated to have any exchequer or economic impacts. Mr. Chair, the Government is committed to supporting R&D investment across the UK through the R&D tax reliefs, which play a key role in supporting our mission to kickstart economic growth. The changes made by this clause will ensure that all companies that were originally intended to benefit from the higher rate of relief will now be able to do so. I therefore move that this clause stands part of the bill.
Mr Davis.
Thank you, Mr Mundell. Clause 30 amends, as the Minister was saying, the transitional provision, clarifying that expenditure which would qualify for R&D expenditure credit is relevant R&D expenditure when calculating the R&D intensity ratio, which determines eligibility for ERIS, as was always intended. This provision has a retrospective effect, and I'd be grateful if the Minister could therefore tell the committee what steps the Treasury is specifically taking to ensure that all those who missed out on the relief but may now be eligible are aware and equipped to claim this new support. Thank you.
Minister to respond.
I would thank the Opposition Minister for his question, and I can reassure him that as ministers and indeed Treasury officials, we are routinely in conversation with the industry, those companies who benefit from R&D support, and we will make sure that all changes to legislation and all opportunities available for us to support them are communicated with clarity and make sure everyone is aware of what support we can offer for their economic growth ambitions.
The question is that clause 30 stand part of the bill. As many as are of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. We now come to clause 31. The question is that clause 31 stand part of the bill, with which it will be convenient to debate government amendments 38 to 43 and Schedule 6. Minister.
Thank you, Mr. Chair. Clause 31 and Schedule 6 make changes to the taxation of employee ownership trusts to prevent opportunities for abuse and to ensure the regime remains focused on encouraging employee ownership. The Government is committed to supporting employee ownership as a viable and sustainable business model. Employee ownership gives employees a greater stake in the business in which they work, improving working conditions and in turn driving productivity and growth. Tax reliefs are currently available for company owners who transition their companies into an employee ownership trust, which is set up to hold and manage the company for the benefit of all employees of the company rather than for individual shareholders. This model has proved successful, with over 1,500 UK companies held by employee ownership trusts today, improving the working conditions of some 200,000 employees. However, whilst the success of the employee ownership model is to be applauded, the Government is concerned that the tax regime is vulnerable to exploitation. The Government is therefore determined to close loopholes to ensure that the reliefs are only available to those who are motivated by a genuine desire to transform their companies into employee ownership. The changes made by Clause 31 and Schedule 6 will therefore amend the conditions for obtaining capital gains tax relief on disposing of a company to the trustees of an employee ownership trust to ensure that the former owners cannot retain control of the company following disposal. The trustees must be UK resident, and trustees must take reasonable steps not to pay more than the fair market value for their shares. These changes are necessary to prevent opportunities for abuse, protecting the long-term integrity of these reliefs. Individuals will also be able to provide additional information to HMRC at the point of claiming the relief, and the period of time within which HMRC can take action if the relief conditions are breached post-disposal will be increased. HMRC will be given additional powers to monitor the reliefs and to take action when non-compliance is identified. And lastly, this measure makes technical changes to provide clarity on the tax treatment of contributions paid to the trustees from the company in order to meet costs associated with purchasing the company from the former owner, and it also adjusts the conditions for income tax relief on employee bonus schemes. These changes overall will simplify the process of setting up and operating employee ownership trusts. Mr. Chair, Government Amendments 39 and 41 confirm that the relief is only available with respect to contributions paid to the trustees from a company for the purposes of meeting the trustee's acquisition costs. In doing so, these amendments clarify the policy intent and remove any potential ambiguity within the legislation as drafted. Government Amendments 38 and 40 ensure that the distributions relief is available in circumstances where the capital gains tax relief was not claimed because the vendor was a company rather than an individual, provided that the conditions for obtaining that relief were otherwise met. Lastly, Government Amendments 42 and 43 expand the scope of the costs that qualify for this relief to include other expenses as may reasonably be incurred by trustees in connection with the acquisition of the company. Mr. Chair, these amendments make technical clarifications and also address concerns expressed by key stakeholders that the scope of the relief, as announced at autumn budget, was too narrow to reflect the reality of how employee ownership trust acquisitions are funded. Mr. Mundell, this clause overall protects the future of employee ownership in the UK by ensuring that the tax reliefs available to encourage it continue to operate effectively and prevent opportunities for abuse. I therefore move that clause 31 in Schedule 6 alongside Government Amendments 38 to 43 stand part of this bill.
Thank you, Mr. Mundell. Clause 31, as the Minister was saying, in Schedule 6, alter the conditions for obtaining tax reliefs for employee-owned trusts or EOTs. The current regime was introduced by a Conservative government following the independent Nuttall Review in 2012, which set out the many strengths of the model and how it could become more widespread in our country. Since the current regime was implemented in 2014, its tax incentives have achieved great success in encouraging the creation of employee ownership trusts, which have become the predominant model for employee ownership. Today, more and more companies are making the transition to this model, and I was pleased to hear the Minister tell us that it's around 1,500 examples in the country. In 2023, we launched a consultation to review this regime, and it's fallen on this government to respond to it. The package of changes which the Minister set out today aims to prevent opportunities for the reliefs to be abused, while ensuring employee ownership continues to be incentivised and supported. These are objectives that we shared and which we warmly welcome today. We will not oppose these measures, which largely reflect the recent consultation. However, as you would expect, I have a few questions. I'd be grateful if the Minister could explain, in a few cases, suggestions put forward in the course of the consultation, why these have not been taken forward. For instance, a large number of respondents asked for the tax-free bonus limit for employees to be increased from the current level of £3,600. Had this kept pace with inflation, the maximum today would be close to some £5,000. The government has made clear that it has no plans to increase the tax-free bonus amount, but it has not said why. A little more detail would be really welcome, as well as some reassurance that the government will keep this element of the regime under review so that it can react speedily if the weakening of this incentive begins to undermine the overall policy goal, which we all share. Another point raised in responses to the consultation was the issue of double taxation upon the sale of an EOT-owned company to a third party. In this event, trustees would be liable to pay capital gains tax on the disposal, and employees would be charged income tax on their share of the net proceeds. When responding, the government did not acknowledge this specific point on double taxation, which has also been highlighted by the Chartered Institute for Taxation. We understand that this concern must be weighed against the main abuse which the government is rightly trying to prevent with the measures today, which is the exploitation of EOTs by company owners to reduce their CGT liability when ultimately selling their business to a third party. But surely the second layer of taxation, the income tax charged to employees, does not act as a major disincentive for this kind of behaviour, especially in the context of additional restrictions being introduced in Part 1 of the schedule to prevent such abuses. I would therefore be grateful if the Minister could address this point or write to me afterwards with clarification on why this was not taken forward. The Minister will be aware of concerns regarding the implementation of the statutory relief for distributions in Part 2 of the schedule. As originally drafted, the schedule only allowed for specific costs, payments made by companies to the EOT to fund the share purchase, interest on outstanding consideration and stamp duty, for example, to be tax deductible, a process which previously would have taken place through a non-statutory clearance request to HMRC. This had the effect of excluding other costs which many thought would be reasonable to cover. I'm glad that the government has listened and brought forward the amendments, some amendments to widen the scope of this relief, and I thank the Exchequer Secretary for his letter to me setting out those amendments. It was a great read. However, other costs, such as payments to cover the fees of professional trustees and advisors for ongoing services, fortunately remained excluded. Moreover, HMRC has limited flexibility to provide relief for any excluded costs now that the relief is on a statutory footing. So, I'd be grateful if the Minister could elaborate on the thought process behind the fine lines being drawn and, in some cases, redrawn in this area. On what basis is the government determining what should and should not attract relief? But as I said, we will not oppose these measures, but I would be grateful for reassurance that in the pursuit of a noble goal, preventing this important regime from being abused, the government is not inadvertently, unintentionally, undermining its attractiveness. Thank you.
Minister to respond.
Well, I thank the Opposition Minister again for his broad support for the changes that we're making and recognising the benefit that these measures can bring in terms of, I think, supporting the integrity of employee ownership for the future, because where schemes become liable to abuse, it undermines support for them and their longevity in some cases. And so making sure that the tax reliefs are well designed is important for making sure that this beneficial structure can continue into the future. He asked a specific question around the level of restrictiveness on the relief for distributions from the company and why the various decisions and conversations were had around extending the relief to other costs which may be incurred by the trustees. And I can tell him that since the autumn budget, officials have met with stakeholders such as the Chartered Institute of Taxation, and they raised concerns about the scope of the distributions relief as initially announced. Their concerns were that it was too narrow to reflect the reality of how employee ownership trust acquisitions are funded. And in fact, as he referenced in his speech, we accepted these concerns and so tabled the amendments I referred to in my earlier remarks, amendments 42 and 43, to expand the scope of distributions relief to cover all other expenses reasonably incurred by the trustees in connection with their acquisition of the company. And as always, I'm grateful for the Chartered Institute of Taxation for their constructive engagement that they have given to my officials in discussing these issues. I think more broadly as well, Mr. Chair, the Opposition Minister raised a series of questions around policy choices, and of course the government keeps all policy under review, but it is a question of finding the right balance when calibrating policies such as this to ensure that it has the desired outcomes, that it uses tools of public policy in a targeted way to achieve the right outcome. But as I've made clear, we were open to feedback from the Chartered Institute when they felt that the terms of certain aspects were too restrictive and indeed tabled these amendments. Of course, many of the key changes being introduced now were, to give the Opposition Minister his credit, the subject of the consultation, the subject of consultation held by the previous government in 2023, which sought views on proposals to reform the tax regime, which we're now putting into play today. And the proposals contained within that consultation that I just referred to were met with broad support from respondents from the core change, and they actually form the core of the changes which we're implementing today, notwithstanding the subsequent changes that we've made. And I think the relationship that we have with the Chartered Institute of Taxation, who he mentioned, and with other stakeholders relevant in this space, really helps to inform the policy decisions that we're putting into law today, as well as any future changes to the scheme we might consider, because we want to ensure this opportunity continues into the future. We want to ensure it succeeds, and making sure that we take proportionate measures to avoid tax reliefs being abused is fundamental to ensuring their longevity.
The question is that clause 31 stand part of the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Government Amendments 38 to 43 to Schedule 6 have just been debated. With leave of the committee, I will put a single question on those amendments, and I call on the Minister to formally move those amendments.
I'll move formally.
The question is that Government Amendments 38 to 43 be made. As many as that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Schedule 6 has just been debated, so we'll proceed straight to the question that Schedule 6, as amended, be the sixth schedule to the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to Clause 32. The question is that Clause 32 stand part of the bill, with which it will be convenient to debate Clauses 33 and 34. Minister.
Thank you very much, Mr Mundell. Clauses 32, 33 and 34 make changes to pension schemes established in or administered by persons resident in the European Economic Area states and bring them in line with the rest of the world. Currently, individuals can transfer some or all of their UK pension savings to an overseas pension scheme, providing it is a qualifying recognised overseas pension scheme. Certain transfers to such schemes are subject to the overseas transfer charge, which is a 25% tax charge on the value of the transfer. However, provided they do not exceed the overseas transfer allowance, UK or EEA residents are excluded from this charge for transfers to qualifying overseas pension schemes in the EEA and Gibraltar. This exclusion was introduced to comply with EU fundamental freedoms in place at the time. As a result, some members can benefit from the double tax-free allowances by taking tax-free entitlements from both their UK scheme and their qualifying overseas pension schemes. So, as a result of changes made by Clause 32, this exclusion from the overseas transfer charge will be removed for transfers from 30th of October 2024. As a result, transfers will be subject to the overseas transfer charge unless another exclusion applies. For example, if the transfer is to a scheme that is established in a country where the member is a resident. This will reduce the number of tax-free transfers made and help keep up to £1 billion worth of pension savings in the UK over the next 5 years. Now let me turn to Clause 33. Concerning the requirements for schemes to be considered overseas and recognised overseas pension schemes. When the UK was a member of the EU, these requirements were different for schemes based in the EEA than in the rest of the world. As a result of the changes made by Clause 33, a non-occupational pension scheme established in the EEA must be regulated by a pension schemes regulator in that country, providing there is such a regulator, in order to be considered an overseas pension scheme. If there is no such regulator, then the scheme provider must be regulated for the establishment and provision of the scheme. Furthermore, a scheme based in the EEA must be established in a country with which the UK has either a double tax agreement, which allows for exchange of information, or a tax information exchange agreement to be considered a recognised overseas pension scheme. These changes will take effect from the 6th of April 2025 and will align the requirements for schemes in the EEA with those for the rest of the world and bring the requirements for non-occupational schemes in line with those for occupational ones. Finally, Mr Chairman, I will turn to Clause 34, which concerns the requirements on administrators of UK registered pension schemes. Under the existing rules for such schemes, the scheme administrator can be a resident in the EEA, which can make enforcement of tax debts from the scheme difficult and costly for HMRC. So, as a result of the changes made by Clause 34, from the 6th of April 2026, next year, all scheme administrators of UK registered pension schemes will need to be a UK resident. This requirement will support HMRC's enforcement activities, as there will be a UK resident for them to engage with. Mr Chairman, in conclusion, the changes made by clauses 32, 33 and 34 will bring the tax treatment of transfers to EEA and Gibraltar pension schemes the conditions EEA overseas schemes need to meet, and the requirements of EEA administrators of UK schemes in line with the rest of the world. I therefore move that these clauses stand part of the bill. Thank you.
Mr Wild.
Thank you, Mr Mundell. As we've heard from the Minister, Clause 32 reduces tax-free transfers from UK tax relief pensions by removing the exclusion from the overseas tax charge. The Government's also announced the linked tax maintenance measures in the other clauses. And Clause 33 makes changes to the conditions for an overseas pension schemes and recognised overseas pension schemes established in the EEA, so that from the 6th of April this year, they must meet the same conditions as schemes established in the rest of the world. And Clause 34 makes changes to the requirements for pension scheme administrators for registered pension schemes, so they must be UK resident. And the ATC, Mr Mundell, was introduced in 2017 to prevent individuals reducing the UK tax due on their pensions by transferring them overseas, particularly to low-tax income jurisdictions, while still benefiting from UK pension tax relief. The 25% charge, which arises on transfers overseas, unless at the point of transfer an exclusion from that charge applies. And at the budget in the autumn, the Government announced they would remove the exclusion of OTC of transfers to qualified pension schemes established in the EEA and Gibraltar, where the member is resident in the UK or an EEA state. And aligning the treatment to transfer made with those to the rest of the world will deal with the risk of a double tax-free benefit. The tax information and impact note says that aligning the treatment of transfers from qualifying overseas pension schemes established in the EEA and Gibraltar with those of transfers to schemes established in the rest of the world reduces the risk of around £1 billion of UK tax relief pension savings being transferred overseas across the scorecard. I'd be grateful if the Minister would confirm how many individuals used the current exclusion and at what cost. It would also be useful to know how much has been raised by the OTC since it was introduced in 2017. The Clause 32 brings to an end that exclusion that can currently be used to transfer to schemes in the EEA. According to the Society of Pension Professionals, in doing so, individuals can benefit from a double-free tax allowance of more than £2 million. The tax note does acknowledge that there will be operational impacts on HMRC caused by the removal of this exclusion, with the need to make changes to forms, guidance and processes to support this. Can the Minister provide an update on how far HMRC have got in preparing all of those updates and changes? Clause 34, as the Minister spoke to, provides that the scheme administrator must be resident in the UK. This means that ahead of the 6th of April 2026, schemes will need to check whether their current scheme administrator will remain valid from this date. Again, the tax information impact note confirms that changing the rules on who can be a scheme administrator for a registered pension scheme could mean some individuals might not be able to pay further funds into a scheme if the pension scheme does not appoint a UK resident pension scheme administrator and is deregistered. How many individuals does the Minister estimate this will impact, and what guidance will HMRC provide to prevent individuals falling foul of the rule change? Again, the Society of Pension Professionals have pointed out that it would be useful if the memorandum could give some indication of how this could impact on schemes where all of its trustees act as scheme administrator, but some are EEA based and some are UK resident. I'd be grateful if the Minister could provide some clarity around that point. As I've set out, we support this change. I look forward to the Minister's response to the technical questions I've raised.
Minister to respond.
Thank the Shadow Minister for his questions. I hope I answer all of them, and if I don't, I promise to answer them with clarification. So he asked some numbers about the number of individuals. I can tell him in 23-24 there were 7,100 transfers to qualifying recognised overseas pension schemes, and the value of those transfers was £1.14 billion. And there is an increasing risk that these transfers were being made tax-free, and that some of these individuals would have been benefiting from the double tax-free allowances. And I note his support for reducing eliminating the risk of that and not allowing people to benefit from double tax-free allowances, which is obviously the main intention of these clauses. He also asked some other questions. He asked about HMRC being prepared and the operational challenges that they might be facing as a result of these changes. I mean, obviously, Treasury ministers and officials work very closely with HMRC. We're in the same building as them too. I can say that, you know, these changes have been drafted and consulted on with HMRC, so I suspect that I can give him some reassurance that everything is in order. Whether individuals will still be able to pay into funds into a registered pension scheme if they do not appoint a UK resident scheme administrator. Some individuals might not be able to get tax relief on further funds paid into a scheme if the pension scheme does not appoint a UK resident pension scheme administrator and if the scheme is subsequently deregistered. However, we do not expect many schemes to be affected by this, as the process for changing scheme administrators is established, and we are, as he will have seen from clause 34, giving a longer lead-in time until early April 2026 for the establishment of these UK administrators. I may not have satisfied all his questions, but I promise that I will write in clarification of others that I've missed. Thank you.
The question is that clause 32 stand part of the bill. As many as are of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. Clauses 33 and 34 have just been debated. With leave of the committee, I will put a single question on those clauses. The question is that clauses 33 and 34 stand part of the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to clause 35. The question is that clause 35 stand part of the bill, with which it will be convenient to debate Schedule 7. Minister.
Thank you, Mr Mundell. Clause 35 and Schedule 7 make changes to alternative finance tax rules for refinancing, which will promote financial inclusion for those who choose to use alternative forms of finance either for religious reasons or otherwise. Now, alternative finance is a method of raising finance that characteristically involves the sale, purchase and renting of assets in circumstances where conventional financing would involve lending at interest. Currently, a capital gains tax, or in some cases a corporation tax or income tax liability, can arise when entering into alternative financing refinancing arrangements, and this would not occur if conventional financing arrangements had been used. Now, this issue mostly affects properties that do not qualify for capital gains tax private residence relief, such as rental properties, second homes and commercial properties. The changes being made by Clause 35 and Schedule 7 will ensure that where qualifying alternative finance provisions are used, individuals and companies will not be liable to capital gains tax, corporation tax or income tax on the transfer of part of the beneficial interest in the asset to a financing institution in order to raise finance. Mr Chair, the Government is committed to the continued strength of the UK Islamic finance sector, providing access to alternative finance to anyone who seeks it. These measures deliver on this commitment by putting alternative and conventional financing on a level playing field in relation to their tax treatment when refinancing. As a result, those who choose to use alternative finance will receive broadly the same tax treatment as those using conventional financing arrangements, and I therefore move that Clause 35 and Schedule 7 stand part of the bill.
Mr Wilde.
Thank you again, Mr Mundell. As the Minister set out, Clause 35 and Schedule 7 make changes to the tax rules that apply to alternative finance. It ensures that where an existing asset is used to raise finance using alternative finance, the tax outcome is broadly the same as conventional financing. The measure aims to level the playing field and we will not oppose it. Currently, the refinancing of a residential or commercial property using alternative finance triggers a potential capital gains tax liability on any inherent gain By contrast, no potential capital gains liability arises when a conventional mortgage is used, and the policy objective of this measure is one we support and acted on in government in other areas, is to ensure that level playing field across those conventional and alternative forms of finance. And the issue affects properties that don't qualify for capital gains tax private residential relief, such as residential properties, and will apply to refinancing entered into or after the 30th of October 2024. And once again, I join with thanking the Chartered Institute for their work and advice in scrutinising this bill and discussions I've had with them about this clause. And the Chartered Institute suggested that the clause could be amended to exempt taxpayers from a liability on inherent gains raised on alternative finance transactions before 30th of October 2024. And making such a retrospective change would be unusual, as they recognise. However, they suggest retrospective change in circumstance where there is an anomaly in the legislation that is both inconsistent with government policy during the time the anomaly exists and adversely affects taxpayers, particularly those with protected characteristics, meets this high bar. So I'd be grateful if the Minister could say whether he has considered that point and what approach will be taken by HMRC to taxpayers who've already incurred a capital gains liability. Can the Minister confirm how many taxpayers using alternative financing will likely benefit from this change? And also I'd be grateful if he could set out what steps HMRC is taking to deal with any potential for fraud. As I say, we support this measure. I'll be grateful to the Minister to respond to my questions.
Minister to respond.
Well, thank the Shadow Minister for his support for these clauses and what we're seeking to do to, as he said, level the playing field between alternative finance and conventional finance through these clauses. He asked the question specifically around the retrospectivity of these changes and whether they could be applied retrospectively. And I'm sure you'll be aware the government does not generally apply tax changes retrospectively. The changes to alternative finance tax rules announced in the autumn budget will apply from October the 30th last year. And I would say that the government appreciates that some alternative finance customers will already have paid capital gains tax on refinancing arrangements, which I think is where this question arises from. However, the government feels that to provide taxpayers with certainty over their tax position and to ensure the law is applied in the way it is intended to be, we do not generally apply tax changes retrospectively and will not be doing so in this case. More broadly, in terms of, he asked about whether we will be taking measures to ensure there is no fraud. It should go without saying that in any measures the government takes, we will ensure there is no fraud. That doesn't apply to this measure any more or less than to any other, because in all tax measures we take, we want to ensure that there is no fraud in terms of how they're used. And so that will be on our radar, as it will be with any other tax changes that we make. In terms of the number of people affected, I know that the government, in the previous government, in fact, in the consultation on the alternative financing tax rules, that which was published in January last year, closed in April, that received 22 responses, including from alternative finance providers, representative groups, tax and legal professionals, academics, and consumers. And of course, this is a sector which we want to see grow as one of the many sectors in the UK economy which will drive economic growth.
The question is that clause 35 stand part of the bill. As many as are of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. Schedule 7 has just been debated, so we will proceed straight to the question that Schedule 7 be the 7th schedule to the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to clause 36. The question is that clause 36 stand part of the bill. Minister.
Thank you, Mr. Mandel. Clause 36 is a consequential amendment that amends the Share Incentive Plan, or SIP, to take account of the introduction of statutory neonatal care pay in the Neonatal Leave and Pay Act 2023. Now, SIP is a tax-advantaged share scheme through which a company can award free shares to employees or enable them to purchase partnership shares through salary deductions authorised by the employee. The SIP legislation requires an employer, when entering a partnership share agreement, to provide a notice to inform the employee of the possible effect of salary deductions on their entitlement to social security benefits such as statutory sick pay or statutory maternity pay. Now, the Neonatal Care Leave and Pay Act 2023 introduced provisions to enable parents whose babies require specialist care after birth to take additional paid time off work. The SIP legislation must therefore be updated accordingly to reflect the introduction of statutory neonatal care pay, which may also be impacted by salary deductions. As a result of the changes made by Clause 36, statutory neonatal care pay will be included in the notice that employers must provide to employees when entering partnership share agreements, alongside other existing statutory payments. This clause will ensure that employees understand the potential impact of salary deductions as part of a SIP agreement on their entitlement to statutory neonatal care pay, and I therefore move that Clause 36 stands part of this bill.
Mr. Wilde.
Thank you, Mr. Mundell. It's a pleasure to serve under your chairmanship. As we heard from the Minister, Clause 36 confirms statutory neonatal care.
It's worth repeating.
Absolutely. It's tax and social security income. And the measure will take effect from the 6th of April 2025, and we support the measure. And it's important to understand the context in which we're discussing today's changes. Since at least 2014, there have been calls to extend parental leave and pay for parents of premature babies in receipt of neonatal care. And I was pleased to stand on a manifesto in 2019 that committed to legislating to allow parents to take extended leave for neonatal care to support those new mothers and fathers who need it during the most vulnerable and stressful days of their lives. And in 2019, the previous government launched the Good Work Plan proposal to support families, which included proposals to do just that and introduce neonatal care leave and pay. And the government responded to that consultation, and that led to the Neonatal Care Leave and Pay Bill, which was later introduced as a private member's bill supported by the government. And that new right, confirmed from the 6th of April, is expected to benefit around 60,000 new parents. It's absolutely right that these measures address some of the difficulties parents face when their baby is in neonatal care. In its explanatory notes for that bill, it notes that the estimated annual costs to the Exchequer of the care leave paid at statutory flat rate would be around £14 million a year on average. I wonder if the Minister has an update on whether those estimates are still correct. It also suggested that the one-off cost of businesses of familiarising themselves with the new legislation was around £4.7 million, with an annual cost of business as a result estimated at £22 million. I wonder if the Minister has updated figures on the impact of introducing these measures. The measures we are discussing here is technical and confirms the tax treatment, but it is important, as the Minister said, that employees make clear the implications to their staff members. But can the Minister confirm what action the government is taking is to communicate proactively about the changes? As I've set out, we support this right to the neonatal care and pay, and I look forward to a response to the specific questions.
Minister to respond.
Thank you, Mr. Chair, and I thank the Opposition Minister for his support for this measure. He asked a series of questions about, if I understood his comments correctly, about the Exchequer impacts and estimated costs of the measure itself, whereas obviously the clauses we're talking about here are really a consequential, relatively minor technical change about what employers have to say when they notify employees who are taking part in the share incentive plan. So I could try to look into that for the Opposition Minister after this committee, but the information that we are discussing today, or the sort of the scope of this clause, is actually much more limited than his questions reflect, because it's really just about employers notifying employees that if they take part in a share incentive plan, then they may have impact on their statutory benefits, which now includes obviously neonatal care pay. This doesn't make any changes to neonatal care pay itself, which is obviously the subject of separate legislation, and that is not impacted in any way by these clauses. So I wouldn't want anyone watching or reading Hansard to be under the misapprehension that we are in any way changing neonatal care pay, which we think is very important. This is purely about making sure that employees who are considering taking part in the share incentive plan are fully informed of what impact any deductions may have, when any salary deductions may have on their eligibility for statutory benefits. Of course, in terms of implementing this scheme, again, I think we may be talking at slightly cross purposes, because this scheme is really, these clauses are really about the share incentive plan and how we make sure that employees are properly informed about how share incentive plan works and the implications of having salary deductions for that, rather than neonatal care pay itself. So that would be, in a way, a separate question to be picked up at another time, because it is a very important change in legislation, one which we are very pleased as part of the landscape of statutory benefits. Having neonatal care pay is very important, but the actual clause we're debating today, again, does not impact neonatal care pay. It is purely about when employees want to want to engage with a share incentive plan, are they informed about the potential impacts those salary deductions might have. So this clause really focuses very much on the share incentive plan, and what we want to make clear is that when entering a partnership share agreement, employees are required, as I said earlier, Mr. Chair, to provide employees with a notice outlining the possible effects of associated salary deductions on their entitlement to social security benefits and statutory payments. And this measure, the clause we're debating today, is purely about that, and it will ensure that this notice must refer to statutory neonatal care pay alongside the other existing statutory payments. I hope that helps to clarify what the scope of this clause is, and that the opposition will continue to support it.
The question is that clause 36 stand part of the bill. As many as of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. We now come to Government Amendment 20, with which it will be convenient to debate clauses 37 and 38. Government Amendments 44 to 54, Schedule 8 and Clause 39. Minister.
Thank you, Mr. Mundell. Clauses 37, 38 and 39 make changes to ensure that from April 2025, individuals moving to the UK who have not been tax resident in the UK for the 10 previous years will not pay tax on their foreign income or gains for the first 4 years of UK residence. Mr. Mundell, for context, the government is removing the outdated concept of domicile status from the tax system and replacing it with a new internationally competitive residence-based regime from April the 6th this year. Currently, where a non-UK domiciled individual moves to the UK, they are able to access the remittance basis of taxation, under which foreign income and gains are not taxable unless they are brought into the UK. Similarly, when undertaking work abroad, newly UK resident non-UK domiciled individuals are able to access overseas workday relief, which means that overseas employment income is not taxable unless brought into the UK. These arrangements create a disincentive to invest in the UK and are being changed as a result of these measures. The changes made by clauses 37 and 39 will provide full tax relief on foreign income and gains to new arrivals to the UK for their first 4 years of tax residence, provided they have not been UK tax resident for 10 years before their arrival. To align with this new regime, Clause 38 and Schedule 8 also extends the period of overseas workday relief to 4 years and decouples overseas workday relief from domicile status to align it with the new foreign income and gains regime. Claims for the relief will be capped at the lower of £300,000 or 30% of an individual's total employment income. Furthermore, the removal of the remittance basis means it will no longer be necessary to keep income offshore to benefit from relief. Mr. Mundell, Government Amendment 20 amends Clause 37 to add an additional category of income to the list of eligible incomes, which will ensure that all eligible income for relief is referenced correctly. Government Amendments 44 to 53 have also been made to Schedule 8, to ensure that the relief on travel costs for qualifying newly resident employees in the UK functions as the legislation intended. Furthermore, Government Amendment 54 amends Schedule 8 to clarify that it is a general direction made by HMRC rather than a public notice. Mr Chair, the Government is committed to making sure everyone who is long-term resident in the UK pays their taxes here. The new regime ensures this will be the case, whilst also being more attractive than the current approach, as individuals will be able to bring income and gains into the UK without attracting additional tax charges. This will encourage people to spend and invest these funds here in the UK, and I therefore move that clauses 37 to 39 in Schedule 8, along with Government Amendments 20 and 44 to 54, stand part of the bill.
Government Amendment 20 proposed to clause 37 as on the amendment paper. The question is that the amendment be made. Mr Davis.
Well, thank you, Mr Mundell. Currently, a person who is UK resident but not UK domiciled currently pays tax on any UK income and gains, but can choose for their non-UK income and gains to be taxed on a remittance basis. Part 2 of this bill provides for the abolition of non-domicile status from April 2025, as the Minister is pointing out, and its replacement with a new regime for the taxation of foreign income and gains on the basis of UK residents. It therefore terminates the current tax regime for those who are resident but not domiciled in the UK, while creating a temporary repatriation facility for historic foreign income and gains to be brought into the UK over the next 3 years. These changes will also be applied to trusts under this bill, and inheritance tax will also be brought into the new residence-based system. Although the shape of the overall package is much the same as the one that we announced in the spring budget of 2024, there are a few notable differences when it comes to the detail. But before I move through the chapters, and we'll spend a bit of time doing that, starting with Chapter 1, I wanted to first, provide some context by noting that net of the reforms we announced in March, Labour's adjustments to the new regime are forecast to raise $12.7 billion over the next 5 years. That means the measure we are considering is the second biggest revenue-raising new policy in this entire budget. Labour's adjustments to the temporary repatriation facility alone accounts for £10.6 billion. So these are significant sums, but they're also highly uncertain sums according to the OBR. There is significant uncertainty, in particular, around the behavioural responses and the size of the tax base according to the OBR's assessment. The OBR also says it's unclear to what extent inflows to the TRF are additional over the long term, rather than bringing forward disposals that would otherwise have attracted full rates of taxation. When the second biggest revenue-raising new policy in your budget is so uncertain according to the OBR, bond market jitters come as no surprise. The emphasis Labour have placed on this policy, which makes up a massive chunk of this finance bill, is compounding their conundrum ahead of the OBR's March forecast. It exacerbates fiscal instability by adding to the risk that revenues won't be as high as anticipated, which brings us back to the same old questions that we've been asking, including in the chamber today. Which taxes will Labour have to raise if there is a shortfall, or which services will they have to cut? The Minister will say that we need to wait for the OBR's revised forecasts, but will those forecasts include an update on these highly uncertain figures? Now, turning specifically to Chapter 1, clauses 37 and 39 introduce the new 4-year 100% relief on eligible foreign income and gains for those arriving in the UK who have not been UK tax residents in the 10 tax years immediately prior to their arrival. I acknowledge that this mostly mirrors the proposals which we put forward in the March budget 2024, but would be grateful if the Minister could nonetheless address the following few points. First, in claiming... Of course.
Thank you. The Honourable Gentleman raises the question of estimates around the level of revenue that were generated by this very important measure. I was wondering if the Honourable Gentleman was familiar with the work of Andy Summers and Aaron Avani at the University of Warwick and the LSE, which modelled a couple of years ago, 3 years ago in 2022, the effect of the 2017 tax reforms on non-DOMs, and therefore use that as a basis for statistical estimates for the current proposal before us. Well, of course, economics is the science that does the best to its ability with the data available. I think there are some quite substantial measures available on the table for this measure.
Well, I'm very grateful. I'm afraid I haven't taken the time to read the academic reports, but I do place great emphasis and value in the work of the OBR, which we established in government, and this new government has taken forward and is, I think, it's already seeking to bolster its impact on our work in the Treasury. And so, if she will forgive me, it is their work that I look at, and their work is saying that this budgetary measure is highly uncertain, which, as I was pointing out, leaves questions for markets, but it also leaves questions for, I think, the Labour Parliamentary Party when it comes to which taxation will have to go up if that figure is not met, and which spending will be cut if that figure is not met. And I'll leave that to the Minister to address in his remarks, of course.
Harriet Cross.
Shall the Minister for giving way. Regardless of the uncertainty, we know from the projections that although the tax intake is projected to peak at about 6 billion, it then tails off by the end of the period to 95 million intake, a huge difference. And by that time, that these spending and costs have been worked into the system, no matter what happens in terms of the uncertainty, at the end of that tax period, there's going to be a huge amount of money that was in the system which now has to be filled. So regardless, this policy, if implemented, will mean that there is a hole in the system at the end of the 29 period, but it needs to be filled some way.
I think that's a very good point. If only I'd included it in my speech. I think that's a very good point, and a classic example of an intervention that adds, I think, to the content of the debate that we're having today on behalf of all those who are going to be impacted by this. The projections over the 5-year period, I think, are important to look at on a year-by-year basis. It will be no surprise to the Minister that I look at these very carefully and look at the timing of when the measures create revenue, generate revenue, when they do not. And there are lots of examples which I could provide of this budget where there are some questions to be asked, and indeed we've been asking them today in earlier sessions. But let me come back to what I was saying about, first, in claiming the 100% relief on foreign income and gains. An individual forfeits their eligibility for a whole host of allowances available to normal UK taxpayers, including the personal allowance. Yet even those who were previously taxed on a remittance basis for non-UK income and gains would still pay tax on their UK earnings just like everybody else. That was surely an uncontroversial element of the old regime which didn't require any attention. So why, if I may ask, has the government taken it upon themselves to make the tax treatment of UK income less favourable as a condition of claiming the new 100% relief, which we of course welcome? Secondly, the biggest concern that has been raised with me regarding these new reliefs by the likes of the now famous Chartered Institute for Taxation that many of us refer to is the requirement to itemise and actively claim each income and gain. As far as I'm aware and can recall, the technical note which we produced alongside our proposals in March 2024 did not insist on this level of specificity and detail, which is quite onerous to those applying. As a basic matter of fairness, it seems wrong that the window for making a claim is so much less than 12 years available for HMRC to issue a compliance check, even more so when the ability to make a consequential claim to correct an error is restricted. The budget claims to introduce a regime which is simpler and internationally competitive, which the Minister outlined in his speech. But these two requirements are neither of those things. So can the Minister explain what exactly the benefit of doing things in this way are? I would be really grateful. Now, the main departure from our proposals comes with Clause 38 and Schedule 8, which introduce financial limitations for overseas workday relief. Is this to compensate for the additional year in which this relief will now be claimable? How significant does the Treasury expect the impact of this alteration to be? I'd be grateful if the Minister could indulge me in outline and explanation on these points. Thank you.
Minister to respond.
I thank the Opposition Minister for his comments. I was going to say for his support for these measures, but I don't know if he explicitly said that. I think he nearly did, so I'll take it as support unless he jumps in to correct me on this. But I think one of the key measures which he highlighted in our package of changes and our legislative measures, which are obviously the subject of the clause that we're debating right now, is the temporary repatriation facility, which is an important feature of the system which we're seeking to introduce. And what this does, and I say this for the benefit of all members to be aware, is to introduce a reduced tax rate for remittances to encourage individuals to bring their capital to the UK, to spend and invest it here. And the fact that it will raise considerable revenue is obviously beneficial for the public finances, but it's also critical to recognise that is a consequence of people bringing money into the UK to spend and invest here, which is obviously something which I'm sure his side of the committee room will welcome as well. The overall scheme that the TRF operates in relation to is the 4-year foreign income and gains regime, which I set out the details of in my earlier remarks. And I think it's important to emphasise that this 4-year foreign income and gains regime is a competitive regime, and it's focused on getting the best talent and the best investment we possibly can from around the world into the UK. And the restriction on 4-year foreign income and gain regime claims that can be made during a check of a tax return is to encourage compliance with UK tax obligations, because obviously that would be an inherent part of the new system we're proposing. I think the Honourable Gentleman asked further questions around what other reliefs those claiming the 4-year foreign income and gains relief would qualify for, and why they're being asked to report their foreign income and gains to HMRC. I think he made a point around reporting requirements and his concern they were too onerous. But what I would say to the Honourable Gentleman is that this information will help the government to evaluate whether the regime is providing value for money and ensure that the relief supports the aim of encouraging talented people from around the world to come to and invest in the UK. Having this information will enable HMRC to identify any avoidance risks and ensure compliance within the new regime. And it means that because all UK taxpayers must report their foreign income and gains, this should be no different for individuals who make a claim for the foreign income and gains regime, because all UK taxpayers would be in that position. I think also additionally, failing to request information could be considered to run contrary to the UK's international information sharing obligations, and that is something which we would want to avoid. So I hope he can appreciate that the foreign income and gain regime is a competitive one. It's one that explicitly sets out to be internationally competitive, to attract people from around the world to come to the UK, to invest their money here, to work to grow the UK economy, to create jobs and wealth here in the UK. We want to make sure people have an attractive regime that they can benefit from when wanting to be part of our mission for economic growth. And I hope he also appreciates the important role that the temporary repatriation facility plays, because the shape of the income from the temporary repatriation facility that he spoke about over the scorecard period is intentional, it's by design. If you look at the tax rates which are charged in the different years, it's 12%, 12%, 15%, and that's deliberately to encourage people to make use of the temporary repatriation facility and not to leave it all to the last year, to try and make sure people make use of that across the 3 years for which it operates. And the key reason behind that, of course, the support for public finances is welcome in terms of balancing the books and supporting our public services, but it's also about encouraging people who are currently non-DOMs to bring their assets to the UK, to spend and invest them here in our country. So, Mr. Chair, I think that the package of measures that we suggested, and obviously we had plenty of political debates around this in the previous Parliament, where the previous government introduced some of the measures, I would argue under pressure from us. I'm sure the opposition member would have a different recollection of how that transpired. But these measures that we're implementing today amend the proposals which we inherited to strengthen them, to make them internationally competitive, and to make sure... I'll give way.
I think just to clarify, I think, for members, the point that I'm trying to make is that the Minister is rightly trying to ensure that this new regime makes the UK as competitive as possible, that assets do flow into our country and we derive revenues from that. I guess the question I had, first of all, is why remove the personal allowance for those who seek to do so? And secondly, the point about the reporting is, I think, valid in terms of monitoring, but does he accept that actually that in itself could make the system more complicated and onerous to those who may consider moving their assets to this country? And in effect, that may result in less money coming through the door, which is exactly why the OBR have rated this as highly uncertain revenue generation. That's the point I'm trying to make.
Minister.
Thank the Honourable Gentleman for his further comments. I mean, to address the point around the OBR, I mean, the OBR is an institution that we are seeking to strengthen, as he alluded to, inspired not least by some of his colleagues' view of the OBR damaging trust in it in the previous government. We wanted to make sure that can never happen again by strengthening its standing in law. And as you'll know, when the OBR is looking at tax changes which are suggested, particularly where they are more complex than simply changing a rate, when they are more involved, it's matter of course for degrees of uncertainty to be associated with the revenue from different measures. But I think the point around the design of the scheme is best answered by explaining that this is about getting the right balance. So he asked about whether the reporting requirements are too onerous. It is a balance between making sure that we minimise the burden on individuals and, of course, businesses who they work for. We want to make sure that we're not putting any onerous requirements on them to report information which is not needed. But at the same time, we want to make sure that we have information to be able to evaluate the regime and to make sure that we identify any avoidance risks and ensure compliance. And it is a constant tension within the tax system to make sure burdens are as low as possible whilst making sure we've got adequate information to prevent against non-compliance and so on. And those are judgments which we have to take as ministers, but we want to take them in the way that achieves the best possible outcome. But to conclude, Mr. Mundell, the overall package which we're proposing with the foreign income and gains regime, where foreign income and gains will see no income tax for 4 years, is more generous, is more attractive than the remittance basis which is currently in place, because it means that those foreign income and gains will not be subject to income tax. So I hope that this package we're proposing not only is very positive for public finances here in the UK, but it also serves as an attractive regime for people around the world with talent and with entrepreneurial spirit and who want to work in our country and invest in our country and help our economy grow, to see that this is a scheme which will help them to do just that. And I commend these clauses to the committee.
Government Amendment 20 proposed to clause 37 as on the amendment paper. The question is that the amendment be made. As many as are of that opinion say aye. Aye. To the contrary, no. I think the ayes have it. The ayes have it. Clause 37 has just been debated, so we'll proceed straight to the question that clause 37, as amended, stand part of the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Clause 38 has just been debated, so we'll proceed straight to the question that clause 38 stand part of the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Government Amendments 44 to 54 have just been debated. With leave of the committee, I'll put a single question on those amendments and I'll call the Minister to formally move those amendments.
Move formally.
The question is that Government Amendments 44 to 54 be made. As many as are of that opinion say aye. Aye. Of the contrary, as many of those are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Schedule 8 has just been debated, so we'll proceed straight to the question that Schedule 8, as amended, be the 8th schedule to the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Clause 39 has also just been debated, so we'll proceed straight to the question that Clause 39 stand part of the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to Clause 40, with which it will be convenient to consider Government Amendments 55 to 58, Schedule 9, Clause 41, Government Amendment 59, Schedule 10, Clause 42 and Schedule 11. The question is that Clause 40 stand part of the bill. Minister.
Thank you, Mr Mundell. And these clauses and schedules also relate to the non-dom reform which we were just discussing in relation to the previous group of clauses. And clauses 40, 41, 42 and schedules 9, 10 and 11, which form this group, make changes to ensure that the remittance basis of taxation will no longer apply from April the 6th this year. For previous users of the remittance basis, a temporary repatriation facility will be introduced, which we've just discussed under the previous group of clauses, and individuals will be able to rebase their foreign assets to the value on April the 5th, 2017. Mr Mundell, as we know well, the government is removing the outdated concept of domicile status from the tax system and replacing it with a new internationally competitive residence-based regime from April this year. Currently, where a non-UK domiciled individual moves to the UK, they are able to access the remittance basis of taxation, under which foreign income and gains are not taxable unless they are brought to the UK. But these arrangements can create a disincentive to invest in the UK. The changes made by Clause 40 in Schedule 9 will remove the remittance basis of taxation from being claimed after April the 6th, 2025, and this clause clarifies how this legislation operates. Although no new claims can be made, foreign income and gains that have arisen to a remittance basis prior to April the 6th, 2025 will continue to be taxed at the prevailing tax rates if remitted to the UK on or after this date. Clause 41 in Schedule 10 would introduce the new temporary repatriation facility for individuals who had previously claimed the remittance basis, through which they will be able to designate and remit foreign income and gains that arose prior to April the 6th, 2025 at a reduced rate of tax. This will include unattributed foreign income and gains held within trust structures. Now, this facility, as we've been discussing in relation to the previous group of clauses, will be available for a limited time period of 3 years, from April 2025 with a rate of 12% for the first 2 years, rising to 15% in the final year. Clause 42 in Schedule 11 will introduce a transitional arrangement for capital gains tax purposes. This will allow those who have previously claimed the remittance basis to rebase foreign assets they held on the 5th of April 2017 to their value at that date when they dispose of them on or after the 6th of April 2025. Now, Mr Chair, Government Amendments 55 and 56 amend the wording of Sections 56, 61G and 61R of the Income Tax, Earnings and Pensions Act 2003 to ensure that these clauses, which cover chargeability to tax in respect of deemed employment payment, no longer make reference to domicile, which has become redundant in light of the current reforms. Government Amendment 57 amends Section 22 of the Finance No. 2 Act 1931, as well as Section 154 of Finance Act 1996 and Section 174 of Finance Act 1993 to ensure that an individual's domicile is no longer a relevant consideration for Treasury securities issued with free of tax for residence abroad conditions. Government Amendment 58 removes references to domicile in Section 614 of the Income and Corporation Taxes Act 1988 relating to relief on income from investments of certain pension schemes which have become redundant in light of the current reforms. And finally, Government Amendment 59 corrects an incorrect reference in Schedule 10. Amendments have also been made to the associated explanatory notes to accurately reflect the legislation. Mr Mundell, the Government is committed to making the tax system fairer so that everyone who is long-term resident in the UK pays their taxes here. This new regime ensures... Yes, I will.
Thank the Minister for giving way and for listing the amendments which are being brought to the committee. At Davos last week, however, the Chancellor announced other amendments which are going to be made to the non-don status, and it's disappointing that they're not being brought here to committee where they can be scrutinised line by line. Why is that not the case, and when will either a committee or the House get to see those amendments?
Minister.
I would thank the honourable member for her question. I'm glad she was paying good attention to what the Chancellor was saying at Davos. And the Government will introduce, as the Chancellor set out, a number of amendments to the Finance Bill at report stage to make the temporary repatriation facility simpler to use and more attractive, whilst retaining the structure announced at the budget. So at report stage, those amendments will be brought forward to make, as I said, the temporary repatriation facility simpler to use and more attractive to those who want to benefit from it. But more broadly, Mr Mundell, the new regime ensures that whilst also being more attractive than the current approach, as individuals will be able to bring income and gains into the UK without attracting an additional tax charge, it will encourage people to bring funds into the UK and spend and invest them here. That is good for the UK, both in terms of investment and spending coming into the UK, and of course the tax revenue, which we spoke about in relation to the previous set of clauses. And I therefore move that clauses 40, 41 and 42, schedules 9, 10, 11 and government amendments 55 to 59 stand part of this bill.
Mr Davis.
Thank you, Mr Mundell. As the Minister was saying, Clause 40 and Schedule 9 abolish the remittance basis of taxation for foreign income and gains from 2025 to 2026. Clause 41 and Schedule 10 create a temporary repatriation facility, or TRF, to allow former remittance-based taxpayers to bring historic foreign income and gains into the UK at a lower rate of tax, while Clause 42 and Schedule 11 allow for foreign assets to be rebased to their value in 2017 for capital gains tax purposes. On the TRF, I will gently point out to the Minister that when this is the single biggest revenue-raising part of Labour's policy, offering a reduced rate of tax on income and gains for a limited time, they're not so much closing loopholes in the tax system as the opposition party at the time consistently said to us, and as the budget claimed, but actually creating new loopholes by their own definition of debates gone past. Especially when you consider the OBR's point that there is great uncertainty, as I've been saying, over how much of that revenue is truly additional. As Tom Josephs, one of the 3 members of the OBR's Budget Responsibility Committee, told the Treasury Select Committee, most of the revenue that we have scored in the forecast comes from what are, essentially, 3 years' worth of lower tax rates. The steady state impact of the reform is much lower. As is so often the case, there is a mismatch between Labour's rhetoric and the policy reality. The same would appear to be true for the tweaks to the temporary repatriation facility which the Chancellor announced on the slopes of Davos just last week. That indiscretion would be more problematic had there actually been any substance to the announcement in Davos. And we're still none the wiser because those amendments, as my honourable friend was saying, have not appeared. This is committee stage of a finance bill where we scrutinise the government of the day line by line. The Chancellor of the Exchequer made a conscious decision to get on a plane, fly to Davos, announce not in this House, but overseas, and then when she has the opportunity to bring amendments for scrutiny to this House, to this chamber today, she has decided not to do that. And I feel sorry for the Minister who has had to explain this, but it's not good enough. He said that we'll be debating at a report stage. But what was it that stopped her from laying amendments today at Bill Committee? What was it about the line-by-line scrutiny that meant she couldn't put them down? I'd be grateful if he could try and explain it, but I think actually she should be explaining it to the House. Now, these points aside, the main grievance which others have raised in response to this section are the changes to definition of remittance in Schedule 9. The Chartered Institute of Taxation says these changes are badly drafted, should not be retroactive, and at the very least, implementation should be delayed to allow for them to be rewritten and consulted on. Otherwise, the Minister needs to explain why, under paragraph 5, subsection 8, lending foreign income to a foreign relative outside the UK to be kept outside of the UK should be treated as a remittance to the UK. Paragraph 5, subsection 11, which makes it so that anything that has ever been remitted to the UK without being charged to tax under previous rules should now be treated as if it was a chargeable remittance, is described by the ICAEW as unacceptable, and they say it should be deleted. This is not a matter that I am particularly expert on, but they are, and I'd appreciate if you could explain on those points or follow up in writing to me so that I can provide those industry bodies with an explanation. Thank you.
Minister to respond.
Oh, thank you, Mr. Chair, and always happy to respond to queries from the Chartered Institute of Taxation, eloquently presented by the Opposition Minister, and we'll make sure that any responses to those are forthcoming. But I think the central point here, which the Opposition Minister focused on in his comments, was around the temporary repatriation facility and our changes to that. And you know, the Chancellor was very clear that these changes, which she mentioned at Davos, are designed to make the system simpler and more attractive. And as he will know, finance bills routinely are amended at both committee stage and report stage by the government to ensure that the best possible legislation is in place before the finance bill gains royal assent. The new temporary repatriation facility, which we are setting up through these clauses, includes rules concerning how income and gains in a trust structure are matched to beneficiaries, and these are complex, and these amendments will simplify that process. The amendments to the temporary repatriation facility, which the Chancellor referenced, for absolute clarity, are separate to the amendments which we are debating today at committee stage, which clarify specific aspects of the legislation and ensures the policy works as intended. But collectively, Mr. Chair, the amendments we're debating today, the government amendments which form part of this group of clauses and amendments, ensure that the legislation works as intended. And the amendments that the Chancellor announced or mentioned at Davos are designed to make the system simpler and more attractive. And if it's a win-win where it doesn't have an impact on the income, I will give way.
Lake Stevenson.
Thank you, Mr. Mandel. I think members on this side are just somewhat confused, Minister. The Chancellor committed to bring an amendment forward. I know you're saying this is going to come forward at a later stage, but why is it so complex that it cannot be brought forward today, such that it can be scrutinised by the opposition?
Well, Mr. Chair, at the risk of repeating myself, some amendments routinely are brought forward during committee and some at report, and they both get scrutiny at both stages of the bill. And the intention of that is to make sure that the legislation is in the best possible place by the time it gets to third reading and receives royal assent. But the focus for us is to make sure this legislation works as well as possible. We are pragmatic about this. We want to make sure it functions effectively. That's why we're seeing technical changes, which we're making by way of government amendment today, and why there'll be further amendments at report stage to make the system simpler and more generous in the way that the Chancellor has set out. But what this is about achieving, Mr. Chair, is a system that makes the tax system fairer in the ways that we've set out, but is also simple and as attractive as possible for people who want to come to the UK, bring their money to the UK, invest and spend it here, and help us to grow the economy.
The question is that clause 40 stand part of the bill. As many as are of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. Government amendments 55 to 58 have just been debated. With leave of the committee, I'll put a single question on those amendments and call the Minister to move the amendments forward.
Move formally.
The question is that government amendments 55 to 58 be made. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Schedule 9 has just been debated, so we will proceed straight to the question that Schedule 9, as amended, be the 9th schedule to the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Clause 41 has just been debated, so we will proceed straight to the question that Clause 41 stand part of the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Government Amendment 59 has already been debated. Minister, to move formally.
I move formally.
The question is that Government Amendment 59 be made. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Schedule 10 has also just been debated, so we'll proceed straight to the question that Schedule 10, as amended, be the 10th schedule to the bill. As many as are of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Clause 42 has also just been debated, so we'll proceed straight to the question that Clause 42 stand part of the bill. As many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Schedule 11 has also just been debated, so we'll proceed straight to the question that Schedule 11 be the 11th schedule to the bill. As many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to Clause 43, with which it will be convenient to consider Government Amendments 60 and 61 and Schedule 12. The question is that Clause 43 stand part of the bill. Minister.
Thank you, Mr. Chair. Clause 43 and Schedule 12 make changes to ensure that the foreign income and gains arising within settler-interested trust structures will no longer be protected from tax for non-domiciled and deemed domiciled individuals who do not qualify for the 4-year foreign income and gains regime which we've been discussing in relation to earlier groups of clauses. Mr. Chair, as we've established in previous debates within this committee today, the government is removing the outdated concept of domicile status from the tax system and replacing it with a new internationally competitive residence-based regime from April this year. Currently, where a non-UK domiciled individual settles an offshore trust, foreign income and gains arising within that trust are protected from UK tax, which remains the case even if the individual is later deemed domicile. The changes made by Clause 43 and Schedule 12 will mean that from April the 6th this year, foreign income and gains arising in settler-interested trusts will be taxed on the same basis as UK domiciled settlers, unless the settler is eligible for and claims the new 4-year regime, regardless of when the trust was established. In addition to this, the trust protections will not apply to the transfer of asset abroad legislation. This will mean that all income arising in a settler-interested trust or underlying company can be taxed on a UK resident settler as it arises, if the transferor has the power to enjoy the income or receives capital sums from the trust or company. Government Amendments 60 and 61 ensure that the onward gifting provisions continue to operate effectively as under the existing regime. These provisions ensure that taxpayers cannot avoid a liability to tax by diverting benefits to other persons not liable to that charge. Mr. Mundell, the government is committed to making the tax system fairer so that everyone who is a long-term resident in the UK pays their taxes here. The new regime ensures this, whilst also being more attractive than the current approach, as individuals will be able to bring income and gains into the UK without attracting an additional tax charge. As we've debated already, this will encourage them to spend and invest these funds here in the UK, and I therefore move that Clause 43 in Schedule 12, alongside Government Amendments 60 and 61, stand part of the bill.
Mr. Davis.
Mr. Mundell, thank you. Clause 43 and Schedule 12 mirror the proposals we set out in March 2024. The Minister will therefore be very pleased to hear that I have not picked up any significant murmurings of discontent on this clause, and I have no further comments.
Minister, do you wish to say anything further?
May I thank the opposition and encourage him to respond on similar terms in future.
The question is that Clause 43 stand part of the bill. As many as are of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. Government Amendments 60 and 61 have just been debated with leave of the committee. I'll put a single question on those amendments and call the Minister to formally move the amendments.
I move formally.
The question is that Government Amendments 60 and 61 be made. As many as are of that opinion say aye.
Aye.
I'm sure that was aye. Of the contrary, no. I think the ayes have it. The ayes have it. Schedule 12 has also just been debated, so we will proceed straight to the question that Schedule 12, as amended, be the 12th schedule to the bill. As many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to Clause 44, with which it will be convenient to consider Clause 45, Clause 46, Government Amendments 62 to 65 and Schedule 13. The question is that Clause 44 stand part of the bill. Minister.
Thank you, Mr Chair. And clauses 44, 45, 46 and Schedule 13 make changes to replace the current domicile-based system of inheritance tax with the new residence-based system. Now, currently, an individual's domicile status determines whether or not their non-UK assets are in scope of inheritance tax. For non-domiciled individuals, personal non-UK assets are not in scope until they become deemed domicile. However, if such assets are placed into a trust, they will remain out of scope in perpetuity, even if the individual later settles in the UK. The changes made by Clause 44 will mean that from April this year, an individual will be in scope for inheritance tax on their personal non-UK assets if they have been resident in the UK for at least 10 out of the last 20 tax years. An individual will then remain in scope for between 3 and 10 years after leaving the UK, depending on how long they were resident in the UK. The changes made by Clause 45 will mean that, subject to transitional points, any non-UK assets with an individual places in a trust will be liable for inheritance tax charges when the settler is a long-term resident. This will also apply to such assets treated as owned by a beneficiary who is a long-term UK resident. Whilst non-UK assets in existing protected trusts will be in the 10-yearly inheritance tax charging regime when the settler is a long-term resident, it is important to note that those non-UK assets in existing protected trusts will be kept out of the settler or beneficiary's death estate. Any new assets put into trust will be fully in scope for trust charges or charges on a death whenever the settler is a long-term UK resident. This matches the current treatment for people with UK domicile. Clause 46 and Schedule 13 make changes to the remaining inheritance tax areas to depend on a person's long-term UK residence instead of their domicile and to provide for commencement. For example, a surviving spouse or civil partner can elect to be treated as a long-term UK resident instead of electing to be treated as a UK domicile, and this will have effect for 10 years. Mr Chair, 4 minor amendments, 62, 63, 64 and 65, have been made to Schedule 13 to insert a missing word, to correct cross-references to the new definition of excluded property in a settlement, and to ensure that all fiscal domicile definitions are removed unless they are needed for a double taxation convention to work. Mr Chair, the Government is committed to making the tax system fairer so that everyone who is a long-term resident in the UK pays their taxes here. The new regime therefore ensures that individuals in the future will not be able to keep their assets out of scope of inheritance tax indefinitely. At the same time, our approach ensures that non-UK assets in existing protected trusts will be kept out of the settler or beneficiary's death estate. I therefore move that clauses 44, 45, 46 and Schedule 13, alongside Government Amendments 62 to 65, stand part of the bill.
Mr Davis.
Thank you, Mr Mundell. As the Minister is setting out, Clause 44 to 46 and Schedule 13 bring inheritance tax into the residence-based system so that it applies to non-UK assets owned outright or held in trusts. This was our stated intention in March 2024, subject to consultation. As the Minister set out, non-UK assets will now be in scope for inheritance tax where an individual is considered a long-term resident. That is, if they have been resident in the UK for at least 10 of the last 20 tax years, which immediately precede the chargeable event. This is subject to a tapered 10-year tail, where a person who was resident in the UK for 20 years or more would no longer be considered long-term resident after 10 consecutive tax years of absence, whereas a person with 19 years of UK residence in the last 20 years would no longer be considered a long-term resident after 9 years, and so on, down to a minimum of 3 years for those with between 13 and 10 years of residence, again in the last 20 years. As far as I'm aware, no details of consultations which have there are no details of consultations which have taken place, and nothing has been published on this. But I am told by the likes of the Chartered Institute for Taxation that certain provisions, such as the tapering of the 10-year tail I just described, were put forward during that process. I would be very grateful if the Minister could confirm to this committee the nature and extent of the consultation that has taken place by the government to inform the creation of these clauses. The one point which, again, the Chartered Institute of Taxation does make is that there is now an anomaly where individuals who leave the UK before the new regime begins on April the 6th are considered long-term residents when the legislation comes into effect, meaning that they will incur an inheritance tax exit charge for trusts they have settled when their long-term resident status ends. As the Institute points out, it seems unfair that a person who has already left the UK should face an exit charge due to legislation which comes into effect following their departure. I'd be really grateful if the Minister could explain that particular anomaly, which seems a little unfair. According to the OBR, these clauses raise very little revenue. I think it's in the range of £100 million a year on average. So the government can afford to get this right, and I'd really appreciate a fuller explanation. Thank you.
Minister to respond.
Well, I thank the Opposition Minister for his remarks. And firstly, he asked about the question of consultation and how we developed these policies. And I think it's worth pointing out that there has been quite extensive discussion about the legislation on a non-domicile status, because the government published a technical note back at Autumn Budget in October 2024 explaining the proposed changes to provide certainty on the rules ahead of them coming into force in April 2025. Officials have engaged extensively with interested specialists and individuals over the summer and throughout the development of this policy, and many elements such as the tapered tail and the transitional arrangements are those proposed by representative bodies. Those representative bodies also told us that people wanted certainty on the proposed new rules as early as possible, which is why we have published information ahead of the finance bill and discussed it with people who might be affected and might have views to add. In terms of the very specific question he asked, I'll write to him with details on that so he has that for his reference. But again, Mr. Chair, the objective with this policy is to make sure that we are achieving our aim of making the tax system fairer, whilst also making the new regime as attractive as possible, internationally competitive, to encourage people to come to the UK, to invest here, to work here, to help create jobs and wealth, to grow our economy. That is the balance that we seek to strike, and we have done that through close consultation and discussion with those affected to get the legislation into the best place it possibly can be.
The question is that Clause 44 stand part of the bill. As many as of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. Clauses 45 and 46 have just been debated with the leave of the committee. I'll put a single question on those clauses. The question is that clauses 45 and 46 stand part of the bill. As many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Government amendments 62 to 65 have just been debated. With leave of the committee, I'll put a single question on those amendments and call the Minister to move the amendments formally.
I move formally.
The question is that Government amendments 62 to 65 be made. As many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. Schedule 13 has just also been debated, so we'll proceed straight to the question that Schedule 13 as amended be the 13th schedule to the bill. As many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to Clause 54. 54, with which it will be convenient to consider clause 55. The question is that clause 54 stand part of the bill. Minister.
Thank you, Mr. Chair. And clauses 54 and 55 make changes to alternative finance tax rules to put alternative and conventional financing arrangements on a broadly level playing field for annual tax on enveloped dwellings. As for the changes made in clause 35, which we debated earlier, these changes promote financial inclusion for those who choose to use alternative forms of finance, either for religious reasons or otherwise. Now, the annual tax on enveloped dwellings is an annual charge payable by non-natural persons, such as companies, owning UK residential property valued at more than £500,000. It is intended to discourage non-commercial enveloping of residential property in a company in order to avoid other property-related taxes, such as stamp duty land tax. The charge is not intended to apply to individuals who use alternative finance to purchase residential property. These clauses fix an issue whereby an unintended annual tax on enveloped dwellings may arise on individuals and financial institutions when using certain alternative finance arrangements. The changes made by Clause 54 ensure that an annual tax on envelope dwellings charge does not arise just because alternative finance has been used to purchase the property. It does this by disregarding the financial institution's interest in the property, so that tax liability is assessed on the basis of the client of the alternative finance arrangement. Clause 55 fixes an error with the existing legislation and ensures that the annual tax on envelope dwellings treatment is the same for those entering into alternative finance arrangements in Wales as it is for those in the rest of the UK. These clauses, alongside Clause 35 that we debated earlier, deliver on the government's commitment to the continued strength of the UK Islamic finance sector by putting alternative and conventional financing on a broadly level playing field in relation to their annual tax on envelope dwellings treatment. I therefore move that these clauses stand part of the bill.
Mr. Wilde.
Thank you very much, Mr. Mundell. As we heard from the Minister, clauses 54 and 55 extend existing alternative finance provisions to ensure the annual tax on envelope dwellings ATED charge only arises where the client is a person within the scope of that charge. And clause 54 extends to land in England, Scotland or Wales, and clause 55 to land in Wales. Alternative finance, as we discussed in clause 35, is a method of raising finance involving the sale, purchase and renting of assets in circumstances where conventional financing would involve lending at interest. And whilst based on Islamic financing, this can be used by both followers and non-followers of that faith. And these changes reflect the approach that we took in government and that the new government has taken on of ensuring a level playing field between conventional and alternative finance transactions where possible, and we support this change. The ATED is an annual charge payable by companies, partnerships with a company member and collective investment vehicles which own residential property valued at more than £500,000, and an enveloped dwelling is a property used or can be used as a residence, for example a house or flat, and owned through a corporate structure. And the amount of ATED that someone needs to pay is worked out through the banding system, with the current chargeable amounts for properties worth more than £500,000 up to £1 million of £4,450. If a property is worth more than £20 million, a charge of £292,000. I'm grateful if the Minister has any data on how much is raised by this tax every year, and if he has any figures per band. And the tax information impact note includes a negative £5 million impact on the Exchequer annually from 2025 through to 2030. I wonder if the Minister could explain what lies behind that. It would also be useful to know how many individuals using alternative finance this measure will impact. Again, I'm grateful to our friends at the Chartered Institute of Taxation for their comments on this measure, and they've queried what they would term the government's piecemeal approach to levelling the playing field for alternative finance arrangements. They've said current legislation does not provide for a look-through to the underlying buyer for SDLT reliefs such as charities relief, group relief and relief for acquisition by a householder from an individual acquiring a new dwelling. The effect is that relief is denied when alternative finance arrangements are in place. This is inconsistent with a policy of providing parity of treatment between alternative finance and conventional financing, and should also be addressed. I'll be grateful if the Minister could confirm whether he will look at those changes and more widely adopting a more consistent approach and horizon scanning to level the playing field. As I've set out, we support this change and I hope the Minister will be able to respond briefly to my questions.
Minister.
Well, I thank the honourable gentleman for his support on this matter. And he asked about how what the receipts are from ATED, from the annual tax on enveloped dwellings. That's the most recent figures from 22-23 show £124 million of receipts from ATED overall. So hopefully that puts the small amount associated with the particular measures that this clause is seeking to introduce and the other clause that we debated earlier into some kind of context. £5 million is the cost of, as the impact of this change, 124 million being the overall receipts in 22-23 from the annual tax and enveloped dwellings. In terms of how many people are impacted by these changes, we recognise it does benefit a small number of finance providers and individuals. We anticipate the number of people who benefit will be low, but it is important to give this confidence to that sector to grow and to make sure that there is a level playing field, which I think earlier on he agreed was very important to make sure that the Islamic finance, alternative finance sector has that ability, has that level playing field on which it can contribute towards our country's economic growth. And these clauses, along with clause 35 that we debated earlier, seek to achieve that goal.
The question is that clause 54 stand part of the bill. As many as of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. Clause 55 has just been debated, so we'll proceed straight to the question that clause 55 stand part of the bill. As many as of that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it. We now come to clause 56. The question is that clause 56 stand part of the bill. Minister.
Mr. Mandel, clause 56 introduces a power enabling changes to be made to stamp duty and stamp duty reserve tax in relation to financial market infrastructure sandboxes. The government is committed to developing the UK's capital markets, and as part of that has announced that it will take forward the private intermittent securities and capital exchange system known as PICES. This power will be used to provide an exemption from stamp duty and stamp duty reserve tax for PICES transactions. This will be a carefully targeted exemption representing a cost-effective approach to boosting growing private companies and supporting our capital markets. PICES is a new type of trading platform that will allow private companies to have their shares traded intermittently, supporting private companies to scale and grow and boosting the pipeline of future IPOs in the UK. Using powers from the Financial Services and Markets Act 2023, obviously taken forward and passed by the previous government, this government will establish the regulatory framework for PICES in a financial market infrastructure sandbox. This will allow the Treasury to temporarily modify or disapply certain pieces of legislation to support market operators to trial new or developing technologies or practices while still achieving appropriate regulatory outcomes. The government published a response to the PICES consultation paper at Mansion House on the 14th of November last year. As part of this, the government will lay a statutory instrument to establish the PICES sandbox by May this year. Clause 56 will allow the Treasury to make stamp duty and stamp duty reserve tax changes by statutory instrument in connection with any exercise of the time-limited FMI sandbox power in the Financial Services and Markets Act 2023. The power will be used to introduce an exemption from stamp duty and stamp duty reserve tax for PICES transactions as announced at the autumn budget. This exemption will boost the attractiveness of PICES, incentivising investors and private companies to participate, and demonstrates the government's commitment to the success of PICES as part of our wider ambitions to reinvigorate UK capital markets to deliver growth. The government will introduce this exemption ahead of the first PICES trading events. The effect of the exemption will be time limited, in line with the duration of the PICES sandbox. Mr Mundell, clause 56 introduces a stamp duty and stamp duty reserve tax power in relation to financial market infrastructure sandboxes, which will be used to provide an exemption for Pisces transactions. This will increase the attractiveness of Pisces and demonstrates the government's commitment to ensuring its success. The announcement of the exemption has been welcomed by stakeholders. I therefore move that this clause stands part of the bill.
Yeah. Mr Wild.
Thank you very much, Mr Mundell. As we've heard from the City Minister, Clause 56 introduces a power enabling the Treasury to make stamp duty and stamp duty reserve tax changes in connection with any exercise of the time-limited financial market infrastructure sandbox power. And this power will be used to provide an exemption from stamp duty for the Pisces system, and we warmly welcome these measures. Like many other parts of the bill that we've discussed today, Pisces trading platform was the previous government's idea, and as part of our commitment to trial new or developing technologies and practices to help companies to scale and grow. While in government we introduced significant reforms to the UK listings regime, supporting public markets and companies choosing to list in the UK, including implementing Lord Hill's listed reviews reforms. As the Pisces consultation noted, a key challenge for private companies in the UK is at an early stage in the growth there are no standardised ways for shareholders to realise their gains or to allow companies to rationalise shareholder base by providing early investors an exit route. Similarly, it's harder for investors to access companies that are not yet operating on public markets. And Pisces provides a regulatory framework for the intermittent trading of private company shares on a multilateral system. And I welcome this government's support for Pisces, which will form an important part of the UK's offer to companies seeking to grow and list in the UK. I'd be grateful if the Minister could provide an update on the estimated impacts that Pisces is expected to have in terms of incentivising current and potential investors to buy shares on Pisces, bringing greater transparency and efficiency. I think that the Pisces will run for an initial period of 5 years, and will the Minister commit to regularly updating the House on the progress of that? There will not be a public market-style market abuse regime. Instead, the FCA will be given rulemaking powers over a disclosure regime. And I'm sure the answer will be yes, but can the Minister confirm her expectation that the FCA will be properly focused on growth as it devises those rules, ensuring that any new rules are proportionate to the objective that we're seeking to achieve here? And the provisions in Clause 56 specifically relating to exempting Pisces share transfers from stamp duty and stamp duty reserve tax. This is something UK Finance and the Association for Financial Markets in Europe, in their response to the consultation, said should be strongly considered by the Treasury to help incentivise use of the platform. And it's also important to generally reduce frictions for companies and shareholders using the platform as far as possible, which is why the FCA rules are very important in that respect. Stamp duty and SDRT both tax transactions that transfer securities between parties in exchange for payment. In 2023, the previous government held a consultation entitled Stamp Taxes on Shares Modernisation. And the government proposed having a mandatory single tax on securities instead of separate taxes for electronic transfers and paper instruments. It was suggested this approach would reduce complexity and was widely supported in the call for evidence responses and by the working group established. And in considering the application of both taxes here today, I'd be grateful if the Minister could provide an update on what the government's view is on the previous government's proposals and if she plans to bring forward any changes in the future. As I've set out, we support the measures here. I'd be grateful for a response to the points I've raised.
Minister.
Thank you, Mr Mundell, and I thank the Shadow Minister for the way in which he's approached this subject. And he's absolutely correct, of course, that the previous government consulted on Pisces in March of last year, and as part of the Mansion House reforms and speech that was delivered by my right honourable friend, the Chancellor, we responded to the consultation alongside the Mansion House speech in November last year. I'm really glad to see that there is cross-party agreement on these issues, and when we were on the other side, we were very constructive in our feedback on such proposals. He's right to say that there are other reforms in this area which came from the Lord Hill Listings Review and others. There were other reviews that were pertinent to capital markets when his party were in government too. He asked me a number of questions. So in terms of estimating the impact of this innovation, I think it's really important to note that many stakeholders in the city and across financial services have welcomed this innovation, not least the Investment Association. So we know that investors and those in the market are interested in this innovation. So I think that there is great optimism about the demand for shares on PICEs, as he asked me about. I'm very happy to update the House on the development of PICEs. We've still got to lay the SI, but I do think the innovation is of interest to members across the House, so I'm very happy to do that. With regard to his questions about the FCA, we at every opportunity are stressing to the financial services regulators that any new rules should be proportionate. So I can assure him that that is the way in which I will approach my workings with the FCA. And really, in terms of his final question, I'm obviously quite new to this position, but I am familiar with the demands for simplification of stamp duty and stamp duty reserve tax. Might make it a little bit easier to say, let alone to pay. And I will absolutely prioritise looking at simplification, because I think that any kind of simplification is good for the market and helps get things going. So very happy to look at that, but I can't give him an exact answer right now. Thank you.
The question is that clause 56 stand part of the bill. As many as are of that opinion say aye. Aye. On the contrary, no. I think the ayes have it. The ayes have it. We now come to clause 57. The question is that clause 57 stand part of the bill. Minister.
Thank you, Mr. Chair. And clause 57 makes changes to the inheritance tax thresholds, so they will continue at the current levels in 28-29 and 29-30. Subject to release and exemptions, inheritance tax is payable if the net value of an estate exceeds the respective thresholds for two bands. The nil rate band, for which the threshold has been £325,000 since 2009-10, and the residence nil rate band, for which the threshold has been £175,000 since 2021. These thresholds rise with CPI each year, but have been frozen in recent years until April 2028 by the previous government. The changes made by clause 57 will fix the threshold at current levels for a further 2 years until April 2030, which will raise £355 million in 29-30.
Give way on that.
I will.
Harriet Cross.
Thank you, Mr. Giving way. We heard earlier that the thresholds for income tax will be unfrozen as of 2028. So just wondering why the thresholds for inheritance tax won't be, and what impact this is going to have, for example, on agricultural property and business property relief. Has the government done an assessment of the number of additional estates that will be brought into inheritance tax past 2028, and how many of these will be family farms?
Well, I thank the honourable member for her question. Broadly speaking, the reason why we've had to take a number of decisions, including some of the more difficult decisions we had to take a budget, is because of the fiscal inheritance we had from the previous government. And I don't need to spend time at this committee rehearsing the arguments on that, because they are well known and widely accepted that we inherited a mess from the previous government and had to take difficult decisions at the autumn budget to fix that problem and to put the public finances back on an even footing and to get public services back on their feet. So in relation to extending the freeze for inheritance tax thresholds, that of course is one of those many decisions, the difficult decisions that we had to take at the budget last year, which I'm sure she is well aware. In terms of the impact of the number of estates who will be paying inheritance tax as a result of the freeze, fixing the nil rate bands is forecast to increase the number of tax-paying estates by 1,400 in 28-29 and 2,900 in 29-30. And this means that the proportion of all UK deaths subject to inheritance tax will rise by 0.2 and 0.4 percentage points in 28-29 and 29-30 respectively, compared to the thresholds rising with CPI. If you look at all inheritance tax measures, the latest forecasts indicate that 37,700 estates will have an inheritance tax liability in 24-25. That's 5.8% of all estates. And this will increase to 66,600 estates in 2029-30, which is 9.5% of estates. So I hope that helps to put in context for her the overall measures. Obviously, the specific changes to agricultural property relief and business property relief we've debated on several times before, and I've shared with the Honourable Lady the data on that, which I'm sure she's well aware of, and the limited impacts that will have in terms of the number of estates affected, with most estates not being subject to any inheritance tax because of the way in which we've designed the reforms to agricultural property relief and business property relief. But as I said, we've debated that in several other debates in this place, and obviously that's a specific part of the system. The locus of the clauses which we're debating today, these two clauses, these two rates which are affected by Clause 57 relate to the inheritance tax thresholds which apply to all estates. And as I said, Mr. Chair, in my response to the Honourable Lady's intervention, the reason the government is taking these decisions and taking measures like this forward is to repair the public finances, given our inheritance from the previous administration. Fixing the inheritance tax thresholds for a further 2 years contributes towards putting the public finances back on an even footing. And I will defend at every possible opportunity our decision to restore that economic stability to the public finances in the UK, because without having that economic stability, it is not possible to boost investment and growth in the way that we are determined to do.
Mr. Davis.
Thank you, Mr. Mundell. Clause 57 fixes the inheritance tax thresholds at their current levels for a further 2 tax years, as the Minister has set out. The nil rate band, which remains fixed at 325,000, has been unchanged since 2009. The residence nil rate band, which comes into play when a person leaves a property to their direct descendants when they die, was introduced at £100,000 in 2017 to 2018 by Conservative government, before being increased by £25,000 in succeeding years. In reaching the current level of £175,000, we delivered on our manifesto pledge of creating an inheritance tax threshold for married couples and civil partners up to £1 million. Since then, the legislative default is for these thresholds to be increased in line with CPI, although Parliament agreed to override this provision in the aftermath of the pandemic and maintain the current thresholds to 2027 to 2028. Although we don't oppose these measures, HMRC have reported that this Labour government's decision to further extend the freeze on the current thresholds for a further 2 years, as the Minister just set out, will mean that it will increase the number of tax-paying estates by 1,400 in 2028 to 2029 and 2,900 in 2029 to 2030. I think it was a perfectly reasonable question by my honourable friend as to why this Labour government has chosen to unfreeze income tax in 2028, but not inheritance tax. I'm afraid the answer we got was not good enough in the context of a budget and a series of measures which has spent £8 billion on GB Energy, an energy company that will not produce any energy or reduce any energy bills, £7 billion on a national wealth fund, which is basically repainting the building of the UK Infrastructure Bank, £9 billion on union pay deals, which came with no reform, no productivity gains, massive pay rises, which, by the way, the OBR have assessed are inflationary, and sure enough, inflation has gone up, interest rates are going to stay higher for longer, it's mortgage payers who are going to pay the price. That is the state of the public finances that Labour inherited. And while we're on the subject, they inherited the fastest growth in the G7, half the deficit. But it's true, they don't like facts, but we know they're not good with numbers. But when you are the fastest growing economy in the G7, that's a pretty good inheritance. On top of the fact that the deficit was 50%, even the Liberal Democrats are saying something, reacting to this. This is a very important point, because people out there want to know why these decisions, these difficult decisions, are being made. And it's important to set out the facts of how the economy was doing when this government came into office. 2% inflation is now higher. Deficit half of what it was in 2000. These are important factors, and I think it was a very reasonable question by my honourable friend to point out the dichotomy and the choices that this government has made. Absolutely.
The election. Thank you, Mr. Chairman. The election last year was quite momentous, landslide election for the new government. I know his comments about the inheritance and the inheritance that, in his impression, was glowing from the previous administration. Where did it go? Where did it go wrong?
So I think where it's gone wrong is that the Labour Party said pre-election that they wouldn't increase national insurance. They've now gone back on that. They said they wouldn't hit farmers. They said they would support farmers. We've now got the family farm tax. I'm afraid, I'll say to the Honourable General, we're slightly veering off topic, as Mr Mundell will point out. But I will just simply gently say to him, I hope he retains his seat at the next election, but this Chancellor, who's completely out of her depth, has made his life a little more difficult. And I think while he's laughing now, I'm not sure he will be in 4 years. But anyway, in the context of more drastic changes to inheritance tax elsewhere in this budget, and the changes to agricultural relief in particular, my honourable friend again asked a question about the assessment of how many of those estates that are now being brought into this regime as a result of the freezing are family farms. I didn't quite hear an answer, and it'd be really good on behalf of all the farmers that we all represent, it'd be really good to hear what the Treasury's estimate as to how many family farms are going to be impacted. Government ministers frequently cite these inheritance tax thresholds in mitigation of their decision to introduce the family farm tax, but this mitigation is being steadily eroded by inflation. By the time the family farm tax comes into effect next year, Labour's excuses will be worth even less than they are today, not least because the OBR forecast inflation will be higher for longer, as I was saying, under Labour, and it's already gone up in this short period of time. It is a shameful exercise in how not to govern, and we'll be held to account going forward. But that's all I've got on this. Thank you.
Minister to respond.
Well, that was a fairly wide-ranging response from the Minister to what is quite a straightforward clause. But I couldn't help but notice, Mr. Chair, that he began by saying that he supported what we're doing in this clause, that he understood that we needed to take tough decisions, that he's not going to oppose this decision to extend the freeze which they began to inheritance tax thresholds for a further 2 years. And then proceeded to explain, I think, why he didn't support it. So I know that the opposition hasn't made up its policy on many things, but it seems even individual members have not made up their policy.
Are you giving me?
I will now.
Yes. I think what I was pointing out is the discrepancy between how they are unfreezing, apparently, or they're not legislating for it, income tax, as we covered earlier. They are keeping the freeze on inheritance tax, which I pointed out we absolutely did, for public finance reasons, not least. So that's a discrepancy. But also that this has been used as a mitigation against the disgraceful family farm tax, which many of us have farmers who are being impacted by. Every year, inflation goes up, and it's going up under Labour. That mitigation goes away. That was the point I am trying to make. And it would be great if you could address that.
Minister.
Well, the honourable gentleman he alleges that there is some discrepancy on this side of the committee. I feel like there's discrepancy within his own views that he's putting forward, because, again, I return to the central point that he seemed to begin by saying he welcomed our measures, that he supports them, that he understands why these tough decisions have to be taken, but then seemed to explain why he didn't support them. And I say this to him that he asked why we decided to extend the threshold freeze for inheritance tax whilst not increasing income tax rates, for instance. But that's a political choice. It's a difficult choice, but it's a political choice. And it's a choice that we've made as a government to make sure that we do not raise income tax. We went into the election saying we wouldn't raise taxes on working people, and that's a pledge that we've kept through our policies on income tax, employee national insurance, the rate of VAT. We made those commitments, and we're honouring them.
Mr MacDonald?
Thank you, Mr Chairman. I wonder if the Minister would consider the fact that the increase in national insurance has harmed the many companies which have really struggled, rather than an increase in top rate of income tax or capital gains tax would at least have hit organisations which are making proper profits and proper money. Thank you.
Well, only in the context of this clause, if the Minister feels that he has a context, I can respond.
I will attempt to link that question to inheritance tax thresholds. I'm thinking rapidly on my feet, struggling somewhat. But if I may, very briefly with your permission, Mr Chair, respond to the point the Honourable Gentleman raised about the difficult decision, one of the toughest decisions we took at the budget to increase employer national insurance contributions. That's a decision that we didn't want to have to take. We had to take a series of difficult decisions because of the state of the public finances, but we recognise it's a difficult decision, and it's difficult for businesses as well. But what we also know is critical for businesses and for the economy more widely is to have the public finances in balance, is to have our fiscal rules met, is to make sure that we have that stability in the economy, because as I said earlier, without that, the investment in growth, which we're determined to pursue, do not have the foundations that we have. Returning to inheritance tax thresholds, Mr Chair, I set out the number of estates which will be affected as a result of the inheritance tax thresholds, and I don't know if the front bench person on the front bench opposition minister is aware of the data which has been put out around the changes to agricultural property relief and business property relief, but the number of estates affected who claim agricultural property relief and agricultural property relief with business property relief is estimated to be up to 530 in 26-27. That's information which I've referred to in the Chamber several times and was in the Treasury Select Committee letter that the Chancellor sent. But to return to the central point here, we are making a number of... is that a vote? Sorry. Yes. Shall I just finish very quickly?
Yes, I think that would
just
be
to, and just to conclude, finally, although confused in his position, I welcome the opposition support for these measures.
I just seek your guys' persuasion, because I would suspend proceedings for 15 minutes, or I could adjourn. We could adjourn the proceedings completely.
If the other side are happy, we'll propose but we can adjourn.
Okay, if then I put the question that yes, the debate now be adjourned. As many as that opinion say aye. Aye. Of the contrary, no. I think the ayes have it. The ayes have it.
Committee Room 9, sound. 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 Committee Room 9, sound.